Today this section, we will talk about financial assets categories and measurement, fair value and amortized cost. Then focus on amortized cost elaboration. A financial instrument is basically a contract that gives one party a financial asset and another party a financial liability or equity instrument. It exists only because there's a financial contract between two parties. From this simple diagram, we can see with a loan agreement signed, it generated a financial asset for loan investor and a financial liability for loan issuer at the same time. At initial recognition, every financial asset starts at historical cost, the amount paid. It is the loan investor to record the loan as financial asset at the price he paid. But after that, it must be remeasured to amortized cost or fair value, depending on the classification of the financial assets or financial liability. Understanding the difference between fair value and amortized cost, or amortized value, is essential for financial instruments under FRS 39. What is fair value? Fair value is the current market price, the amount the asset could be sold for, or liability settled for, in an orderly, arm's-length transaction, at the reporting date. It is current market value, based on market data, not the company's records. Changes in value, no matter gains or losses, are recorded in P&L, or other comprehensive income, depending on category. As it is based on market data, therefore, normally it is more volatile. What is amortized cost? Amortized cost is the initial amount adjusted over time for repayments, interest income, expense, and impairment losses. It reflects historical value adjusted over time, based on effective interest rate. No revaluation to market, only interest income and impairment affect carrying amount. It is more stable, as changes only when amortized or impaired. Let us have a look at the four financial asset categories under FRS 39. First one, financial assets at fair value through profit or loss, it is called FVTPL. It is measured at fair value, any changes in value go to profit or loss. It's acquired mainly for selling in the short-term, example like trading securities or bonds. A brokerage firm buys listed shares weekly and sells within days. It normally records under balance sheet as current assets. Typical holder of this type of asset are banks, brokers, investment funds. Second category, held to maturity, it is measured at amortized cost, using effective interest rate. Example like bonds held to collect interest and principal, the key notes here is that the company must have positive intent and ability to hold to maturity. Two conditions are both required. The company buy a bond from the market. If management genuinely plans to keep the investment until maturity and the company's financial and liquidity position allows it to hold the asset until maturity, then the bond is classified under financial assets held to maturity, under non-current assets, and value at amortized cost. The third category is loans and receivables, which is measured at amortized cost. The typical examples are trade receivable and loan receivables. It is non-derivative, it's a straightforward asset, not one whose value changes based on another item, like a derivative contract, such as options or swaps. It is with fixed and determinable payments. The amounts to be received are known or predictable, there's a fixed repayment schedule or agreed amount. The fourth category is available for sale, measurement is fair value, any changes in value will go to other comprehensive income. Examples like equity investments not held for trading, it is long-term or strategic investments, not for frequent trading. Normally held by ordinary companies, long-term investors. Once the asset is sold, the gain or loss becomes realized. So, the amount accumulated in other comprehensive income is reclassified, moved, to P&L. If the asset's fair value drops significantly or permanently, it's considered impaired. At that point, the unrealized loss accumulated in other comprehensive income must also be reclassified to P&L. After understand the four categories of financial assets, we will see one example of accounting record for fair value through profit or loss, FVTPL. An investment company bought one bond with face value $100,000, coupon 5% per year. Purchase cost was $98,000. At year-end, its fair value, the market value was $97,000. The price dropped, so it was not sold, and to record it at fair value. The fair value change was $1,000, which is unrealized loss under P&L. Let's look at amortized cost. Bond held to collect principal and interest is under Category 2, held to mature. It is valued at amortized cost. From the scenario stated here, we need to understand what is coupon rate and effective interest rate, or called effective yield rate. The coupon rate is the fixed rate of interest stated on the bond certificate, which determines how much cash interest the issuer will pay to the bondholder each year. It's based on the bond's face, par, value, not its market price. So under this scenario, the coupon rate is 5%, the cash coupon received every year is bond face value 100,000 times coupon rate 5%, so it is $5,000. This is the actual cash received. The effective interest rate is the rate that exactly discounts the expected future cash flows of the bond, interest plus principal, to the bond's current carrying amount, purchase price. For this scenario, the effective interest rate is 6%. So the interest income using effective interest rate is $5,700. This is the interest income recognized in P&L. The amortization of discount is the difference between interest income and cash coupon, which is $700. Therefore, after 1 year, the bond value increase with $700 with the amortization of the discount. How to calculate the effective interest for a bond at purchase? It can be done by solving this equation here, usually by financial calculator. The bond contract is identical, but each investor's effective interest rate is different, because they may pay a different price in the secondary market. The effective interest rate always matches the market yield. When the bond is purchased, the investor's effective interest rate equals to the market yield at that time, regardless of whether it was bought at discount or premium. That effective interest rate, fixed at purchase, is used throughout the bond's life for amortization. You may ask why we use the effective interest rate to amortize. From economic rationale, effective interest rate gives the constant rate of return the investor actually earns, given the price paid, and all future cash flows, coupons plus principal. Accounting reason, the effective interest method allocates interest income, or expense, over the life of the instrument, so that the carrying amount increases or decreases to the redemption amount at maturity. It reflects the true economic yield, not just coupon receipts. The result of using effective interest rate to amortize, interest recognized each period equal to opening carrying amount times effective interest rate. The difference between that interest and the cash coupon is the amortization of any premium or discount. This produces a consistent, principled pattern of interest revenue or expense. A bond can be purchased at discount, at par, or at premium. It is depending on the relationship between the market interest rate and the bond's coupon rate. Given bond face value is 100, if purchase price below face value, it is discount bond, normally market yield is greater than coupon rate. If purchase price is equal to face value, it is par bond, market yield is same as coupon rate. If purchase price is higher than face value, it is premium bond, market yield is less than coupon rate. It is important to note that bonds trade at a discount when investors require a higher return than the bond's coupon. Bonds trade at a premium when investors are willing to accept a lower return than the bond's coupon. What happens over time with amortization? At maturity, always ends at face value. No matter discount or premium, if the bond is held to maturity, the amortized cost method ensures carrying amount at maturity equal to face redemption value. Because the discount is fully amortized, added to carrying amount over time. The premium is fully amortized, subtracted from carrying amount over time. And the issuer, or borrower, repays the face value at maturity. For easy understanding, let's go through a simple case of a bond at discount. The company buys a corporate bond with face value, $100,000. Coupon, 5%. Term, 5 years. Market yield, effective rate, 6%. Purchase price, at discount, $95,788. This bond is held to collect principal and interest, so it is measured at amortized cost. First year, opening carrying amount is the purchase price, $95,788, interest, based on effective interest rate 6%, is $5,747, which is recorded under accrual interest income. The cash received from issuer is $5,000 based on coupon rate 5%. The amortization amount is the difference between accrual interest and cash received, it is $747. This amortization amount will add to opening carrying amount, which increased the closing carrying amount to $96,535 by end of first year. By end of the 5th year, end of the contract, the discount has been fully amortized through interest income over the bond's life, and closing carrying amount is $100,000, which is equal to the redemption amount to receive from issuer. Next, let's go through an example of bond at premium. The company buys a corporate bond with face value $100,000, coupon 6% per year. Term 5 years, market yield or effective rate 5%, purchase price at premium $104,330. This bond is held to collect principal and interest, so it is measured at amortized cost. First year, opening carrying amount is the purchase price, $104,330, interest based on effective interest rate, 5%, is $5,217, which is recorded under accrual interest income. The cash received from issuer is $6,000, based on coupon rate 6%. The amortization amount is the difference between accrual interest and cash received, it is minus $783. This amortization amount will add to opening carrying amount, which decrease the closing carrying amount to $103,547 by end of first year. By end of the 5th year, end of the contract, the premium amount $4,330 has been fully amortized over the bond's life, and closing carrying amount is $100,000, which is equal to the redemption amount to receive from issue. A summary of the logic: first, bonds trade at discount, or premium, or par, depending on market yield versus coupon. Second, effective interest rate equal to market yield at purchase date. Third, amortized cost method uses effective interest rate to allocate interest and amortized discount or premium. Fourth, at maturity, carrying amount always equals face value, because the bondholder will receive the face value in cash. It is all for today. Hope it is useful to you. See you next